You look at the market today and see tech and artificial intelligence ETFs posting explosive returns. It is completely natural to look at your standard index funds and wonder if playing it safe is actually a massive mistake. Many of the funds boasting the most exciting recent gains often harbor the most severe drawdowns. Under the surface, these ETFs are built on completely different risk profiles. This chart shows exactly how that risk manifests. On the left, you see the massive positive returns for funds like TQQQ and MAGs during the good years. But when the trend flips, like the rate shock of 2022, leveraged tech collapsed by over 80%. Meanwhile, a standard S&P 500 baseline, VOO, experienced a normal, survivable correction. Sustainable wealth depends on finding a strategy you can financially and emotionally survive during an inevitable market crash. On the surface, funds like VOO, QQQ, MAGs, and TQQQ all look like simple index funds. Economically, they represent different investment philosophies and wildly different levels of fragility. This pyramid maps how these funds stack up. At the foundation, you have broad market core holdings like VOO and SPY. Above that are growth engines like QQQ. Next up are concentrated mega-cap bets like XLG and MAGs. And at the glowing red peak sits leveraged speculation like TQQQ. Moving up this pyramid does not guarantee higher long-term returns. It exponentially increases your exposure to shifts in market leadership. To build a durable portfolio, you have to match your specific emotional endurance to the correct tier. We start at the foundation. VOO is designed to own the entire U.S. large-cap market. You pay a near-zero fee to capture the long-term economic compounding of the broader economy. You often hear SPY used interchangeably here, but there is a clear distinction. SPY is excellent for institutional liquidity and options trading. For long-term holders, VOO is mathematically superior because its expense ratio is just 3 basis points, compared to nearly 10 for SPY. The trade-off at this foundational tier is simple. During a tech-led bull market, you will underperform hyper-aggressive growth portfolios. VOO is boring. In a crisis, like 2008, it can still drop 30 to 50%, but it is the only tier guaranteed to survive sector-specific rotations. Boring survives. Stepping up one tier brings us to QQQ. This is your growth engine, a concentrated bet on high-margin, non-financial innovation and technology leaders. This tier carries severe valuation risk. In the late 90s, for example, the market priced innovation for perfection, leading to extreme multiples that eventually snapped. When the tech bubble burst, investors learned that world-changing businesses can still deliver terrible investment returns if the starting price is too high. This chart shows the brutal math of that collapse. Look at the line tracking QQQ. It falls violently, down 36% in 2000, 33% in 2001, and 37% in 2002. The broader S&P 500 dropped as well, but the impact was much more manageable. Growth ETFs like QQQ are powerful, but they work best bought after a deep valuation reset. Moving to the upper middle tier, we find concentration satellites like XLG and MAGs. These funds aggressively bet that today's biggest tech and AI winners will keep dominating the market. Buying these funds creates an illusion of diversification. The S&P 500 is already top-heavy. By mid-2025, the 10 largest companies represented roughly 40% of the entire index's value. Because of that overlap, adding QQQ and MAGs to a VO foundation simply multiplies your exposure to the exact same top 10 tech stocks. Extreme concentration is profitable during an AI boom, but it creates acute fragility. If leadership rotates away from big tech, your entire strategy reverses at the same time. Finally, we reach the peak of the pyramid, TQQQ. This is a tactical trading sleeve that resets every single day. Because of how it resets, a 3 times daily return does not equal a 3 times long-term return. This is volatility drag. If the Nasdaq goes up 10% on day 1, TQQQ goes up 30%. If it drops 10% on day 2, TQQQ drops 30%. Look at the result. After that quick up and down swing, a $100 investment in the baseline Nasdaq is down only 1%. Your $100 in TQQQ is down 9%. The path upward must be incredibly smooth for the leverage to actually compound. In a down market, that drag is devastating. During 2022, TQQQ lost roughly 80% of its value. To recover from an 80% hole, you need a 400% gain to break even. TQQQ amplifies potential returns, while simultaneously increasing the risk that volatility will force you to abandon your strategy. Since there is no perfect zero-risk ETF, you have to build a structure you can actually hold through the next financial crisis without panic selling. This matrix outlines portfolio models based on risk tolerance. The Sleep Well compounder is an 80% VO, 20% QQQ split, offering innovation while keeping concentration manageable. The growth compounder and AI satellite models reduce VOO to 60%, adding a 10% wedge for megacap funds like XLG or MAGs for more aggressive growth. In all of these core models, broad market VOO remains the majority. That anchor is what prevents a total behavioral collapse when a single sector corrects. For those using a tactical high-growth model with a 5% maximum in TQQQ, use a strict trend filter. Only hold TQQQ when the price is above its 200-day moving average. When the price breaks that line, exit the leverage immediately. Wealth belongs to those who build a resilient structure and stay invested long enough for compounding to finish the job. Your strategy matters more than any single ticker. To explore these strategies further, join the deepvalues.ai community for advanced research and intelligent multi-agent deep value intelligence. You can also search for and download the Buffett Indicator app on the Apple App Store to track total market temperature and valuation metrics. This video relies on public sources and is not financial advice. Always do your own due diligence. If this breakdown was helpful, hit the like button and subscribe to our sister channel, Deep Values, for more insights.